Hello everyone. Today we're solving the multiple choice question number 1 from the COMM 217 Winter 2016 exam. So there are 10 questions here. They're each worth 1.5 marks for a total of 15 marks. So let's just get right into it. The first question is about price-earnings ratio. Okay, and they're asking which one of the statements is true. So we know price-earnings ratio is the price of the share over the earnings per share. Okay, so if I have a price of $100 per share and an earnings per share of 5, that means my price earnings, my PE ratio is 20, which means the stock is selling 20 times more than it earns. Okay, so what does that mean? Well, is it a ratio of importance to creditors? Not really. Creditors are more important and more concerned with a company's ability to pay, and this really does not give any that kind of information a creditor would be looking for. A high PE ratio indicates investors have little confidence in the future of the company. Okay, well that's not true, because if you're willing to pay $100 or 20 times what a stock is earning, okay, and someone else is willing to pay 30 times more than what a stock is earning. So let's say this was, you had 20 and you had a PE ratio of 30. Okay, well, a higher PE ratio, okay, means you're willing to pay 30 times what it's earning versus 20 times what it's earning. So if you're willing to pay 30 times more than what it's earning, it must be because you have a lot of confidence in this company. So this is false. It's actually the opposite. The PE ratio could be used to approximate the value investors would be willing to pay. Okay, so this is the key, and this is the answer. Okay, so in this case, PE ratio of 20 approximates the value that an investor would be willing to pay for this share. Let's just look at the fourth one just to make sure that that's not true. PE ratio increases as net earnings increases. So let's compare this to our PE ratio of 20 here. Okay, and this is based on 100 over 5. So let's say the earnings did increase, so we would still have a price of 100 over earnings. Let's make them, instead of 5, let's make them 20. So I have a PE ratio of 5, which is lower than 20. Okay, so the PE ratio increases as net earnings increases. No, it decreases. And we see that it decreases to 5 from 20. Number 2, which of the following statements is false? And this has to do with depreciation. So we're looking for something that is not true. That is false. So the first one is true, because you can change the method if the change can be justified because it provides a better measure of the company's net earnings. Okay, this is true. You cannot change depreciation to manipulate earnings, but if it provides financial statement usage with a better measure of the company's profits or losses, then they can change. A change in estimate, so when you change depreciation method or anything that involves the depreciation calculation, the company is required to go back and recalculate and restate all prior year's estimates of depreciation. Well, this is not true. This is false. So any changes are applied prospectively. Means to the future only. Because you don't go back and restate, you just determine what your new depreciation is going to be, and you apply that from today onwards. You don't go back to yesterday. So this is false. Okay, so the others must be true. Let's see, a change in estimate is frequently necessary because the estimates of useful lives or residual values may change because conditions change. That is true. Either a change or estimate or a change in method can be justified on the basis it provides a better measure of earnings. So this is another way of restating what A says. So if A is true, D is true too. Okay, so the only one that's false or not true is B. 3, company uses the direct method for the operating section of the cash flow. Which of the statement is true, if any? So we're looking for a statement that is true. And remember, this company is using the direct method to calculate cash flow from operations. Okay, so this is very different from the indirect method where you start off with net income and you keep on adjusting that net income figure to determine what your cash from operations is. So gains, let's read through each one to see if it's true. The first one is not true because they're not added in the operating section. This is true for the indirect method, but not for the direct method. Dividends paid to shareholders are deducted in the dividends paid to shareholders are deducted in the operating section. This is false. Okay, they are deducted in the financing section. When you pay a dividend in cash, it's a financing activity. Depreciation expense is deducted in the operating section. This is true for the indirect method. Okay, therefore it's false for the direct method. Okay, getting back to A, gains on sales, true for indirect, but false for direct. Okay, so this question really tests your ability to distinguish the elements that go into the direct method versus the indirect method. So all of these statements are false, false, false. Therefore, D is the correct answer. Question number 4. Company issues a 5-year 8% 60,000 note payable on March 1st. The terms of the note include a blended payment of $1,217 per month, and they're asking you for the entry to record the second payment. Okay, so each month, okay, there is a payment of $1,217. Part of that payment goes to interest expense, and part of it, the other part, goes to reduce the principal, okay, or the gross amount that you owe. So let's just go through this month by month. Okay, so month number 1, okay, your payment is $1,217, and part of that payment will be for the interest, and the other one will be your reduction in principal. Okay, so at the first month, okay, remember your original note was for $60,000. Okay, so the interest on this for the first month is $60,000 at 8% for 1 month. Okay, so your interest payment for the first month is $400. Therefore, the remainder, or $817, is your principal. Okay, so this is 1217 minus $400. Okay, but they don't want to know the first month, they want to know the second month. So for the second month, you're still paying $1,217, and the amount of interest, okay, that's going to eat up part of this amount is not $400, but it's lower because your principal has been reduced by $817. Okay, so your new principal is $60,000 minus the $817,000, which gives me $59,183, and you multiply that by the 8% interest charged, and that is the amount of interest expense for month number 2, 1/12, sorry. And this is 1/12 too. So 1 month. Let me just Oops, sorry. Whoa. Okay, so let's just go back here and clean this up a bit. Oh, sorry, I'm having trouble here. %, times 1/12 is equal to 400. And number 2 here, interest for the second month, so I'm reducing my principal amount by the amount of interest, which is a reduction in principal, okay, which is right here. And I'm multiplying that by 8% times 1/12, and that's going to give me $395. So the interest for the second month is $395. That means your principal is going down by the difference, which is in this case $822. Okay, because this is 1217, your total payment, plus the amount of the total payment that's allocated to interest. So you have a reduction of $822 in your principal for the second month. Okay, so the answer to this, okay, so you're going to do interest expense. This is the journal entry, $395. Note payable, $822. You're reducing your principal, and you're going to record the fact that you're paying your standard $1,217 cash. So the correct answer to 4 is a debit, either a debits to note payable for $822, yes. Credit to cash for 1, debit to cash, no, it's a credit to cash, we can see right here. Debit to interest expense for $400, no, it's $395. Debit to notes payable for $817, well, that would have been in month 1, not month 2. So the correct answer is A. The 5 is statement of cash flow question, and they're telling you that they use the direct method for operating to determine the cash flow from operations. And during the 2015, the rent expense was $40,000, and during the same period, prepaid rent went down by $6,000, and rent payable went up by $2,000. Okay, so the way I'm going to do this, okay, I'm going to just reserve a little section for here, for this question here. I'm going to go through the journal entries for each one of these. So I'm going to make 3 journal entries, okay, to record rent expense in 3 parts. Okay, so we know that the total rent expense has to be equal to $40,000. Okay, so let's look at this $6,000. Okay, so during the same period, prepaid rent decreased by $6,000. So in order to decrease prepaid rent, I had to credit the account, right? So this is the entry there. So the only debit this could be is rent expense. Okay, so part of my rent expense for the year, which is included in this $40,000, was recorded by reducing a payable, which means we paid this in the prior period. Okay, $6,000 of this $40,000 was paid in a prior period. That's what it means. Okay, the other $2,000 rent payable increased by $2,000, so let's just record that. Rent payable, $2,000 credit. Oops, credit. Okay, that's what that means. Rent payable increased by $2,000, and the debit, rent expense, was recorded at $2,000, and this means we incurred rent expense, so but we're only paying it in a future period. Okay, so that's why the rent payable has gone up by $2,000. So the difference here is we've got accounted for $6,000 of rent expense, another $2,000 of rent expense, so that's $8,000. So it must mean that the remainder, okay, which is 40 minus 8, $32,000, was paid in cash. Okay, so this is one way to look at it. The other way to do it is to start off with your rent expense of $40,000 and reduce it by the decrease in prepaid, which means you're incurring rent expense, but you've prepaid this, so this reduces your cash. And your increase in accounts payable rent, which means you're incurring rent expense, but you're only paying it in the prior period. Okay, so this gives you the same answer of $32,000. So the correct answer is A. Moving on to the next question. Okay, this is again a statement of cash flow question using the direct method. So they're telling you that during 2015, sales were 100,000, 70 on credit, which means 70,000 AR and 30,000 cash. During the same period, the AR increased by 2,000. So they're asking you what was the cash collected from customers in 2015. Okay, well, the easiest way to do this, okay, is to, one way to do it is to create a T account. Okay, so for 2015, so they tell you the sales were 100,000, 70% on credit, so we know we did something like this initially. Debit AR, 70,000, credit sales, 70,000. Okay, so 70,000 would have been a debit to accounts receivable. We would have done cash, 30,000, and sales, 30,000. Okay, so I'm collecting cash of 30,000. During the same period, accounts receivable increased by 2,000. Okay, so we know the difference between the opening AR and the closing AR is 2,000. Okay, the other thing we know is any credits to the AR account are collections. Okay, cash collections from customers. Okay, so the increase, let's assume our opening AR balance was 0. Okay, and if they're telling you that during the period the AR increased by 2,000, well, an increase of 2,000 in this little example would mean that the ending balance of the AR is 2,000. That means I can solve for my cash collections. Therefore, this is equal to $68,000. Okay, so you collect cash. Cash collections from customers comes from AR and your cash sales of 30. So the correct answer is 68,000, okay, which is your cash collections from the AR, and your $30,000 in cash sales, for a total of $98,000. Okay, so the correct answer is A. And just again, a little aside here, you know, if you use any two numbers, okay, here, any two numbers, as long as the difference is 2,000, which means as long as the closing balance is greater than the opening balance by 2,000, you'll get the same answer. So let's just assume my opening balance was 500,000. And if my AR increases by 2,000, well, that means this is going to be 502,000. X is still $68,000. Okay, so any two numbers is going to get you this amount of $68,000. Okay, so that's it for number 6. For number 7, we have a company that bought a truck for $60,000. It had a useful life of 5 years, residual value of $5,000. At the beginning of the year 3, so after 2 years, the managers concluded that the total useful life would be 4 years instead of 5. No change in the estimated residual value. What is the amount of depreciation for year 3? Okay, so we have 1 year, 2 years, 3 years, 4 years, and 5 years initially. Okay, so for the first 2 years, okay, we depreciated based on a residual value of 5 and a useful life of 5 years. Okay, so initially, for the first 2 years, we were doing this, $60,000 minus $5,000 of a residual value over 5 years was giving us $11,000 per year. Okay, so $11,000 was recorded as depreciation in year 1 and as depreciation in year 2 as well. Okay, in year 3, okay, this is where the change happens. Okay, so what is the change? Well, it's good for another, it was the total useful life, okay, would be 4 rather than 5. Okay, so that means the following. Okay, so it means that the useful life is in total 4, so we only have 2 years of depreciation left on this asset, not 3. Okay, so whenever we have a change, we have to compute the new depreciation, and the first thing to do is to determine the carrying value of the asset. Okay, and that simply, it's also known as the net book value, and it's computed as cost minus the accumulated depreciation. So in our case, we had $60,000 the original cost. We have $22,000 of accumulated depreciation on this asset so far. So our new carrying value is $38,000. Okay, this is my new carrying value. So my new depreciation will be $38,000 minus the residual value, which is not changed. Over how many years? What is the remaining useful life for this asset? It's 2 years. So that means my annual depreciation is $33,000 over 2 years. That's going to give me $16,500. So the correct answer here is D. 8, which of the following statements is false? So I'm looking for something that's not true. Okay, and we're looking at depreciation expense. So A says depreciation expense is added to net earnings in the operating activities section of the statement of cash flows because it has no effect on cash on net earnings under the indirect method. Okay, do you remember correctly? We start off with net income and we add back non-cash items. So this is true. And why is it true? Because depreciation is not a cash outlay. In other words, when you record a depreciation expense, you're going to debit something, and what do you credit? An account called accumulated depreciation. Okay, there's no cash involved here. Okay, so depreciation, what depreciation is an allocation of a cost incurred in a prior period to the future periods that will benefit from that asset. So this is true. Depreciation is not a cash outlay, which means it's added to net earnings. Okay, so A is true. B, depreciation expense is included in the investing activities of the section of cash flow. Well, this is false. Okay, because it's added in, is included, no, this is false. Okay, it's not included in the investing activities. The actual cost of the asset, is included. Okay, if paid with cash. Okay, so the acquisition cost paid in cash is included in the investing section of the cash flow statement, but not the depreciation expense. So this is false. So let's just see if the other two are true. The only cash effect for depreciation is the tax savings provided by its deduction to derive a taxable income. Okay, and this is true. Depreciation expense reduces net income. Therefore, you save tax. The more depreciation expense you have, the less taxes you pay because it decreases net income. So that's true for D. Depreciation is a non-cash expense that reduces net earnings but involves no outflow of cash. So this is true. So the answer is B. 9 is about a lawsuit, and this liability, the liability that could arise as a result of this lawsuit should be recorded in the books if the probability of Jake owing money as a result of the lawsuit is D, probable. Look in your book, probable. 2 conditions. So the payment of a certain amount of money has to be probable, and then the amount has to be reasonably estimated. So the answer is D. 10 has to do with deferred income tax. So this is all due to timing differences. Some revenues may not be taxable in a year for tax purposes, but for accounting purposes it is. Same for expenses. They may not be taxable in one year, but included on your statement of earnings for 1 year. So let's just see what's happening here. So I'm going to do it this way, net income for this company. So they reported $40,000 of net income. The income tax return excluded a revenue of $3,000 reported on the statement of earnings because it won't be included in your tax return until 2016. So for tax purposes, or my taxable income, okay, it's not $40,000 because $3,000 of this is excluded for tax purposes. So we're only going to be paying this year income tax on $37,000. Okay, so and this is 2015. This $3,000 will be reported in 2016 for tax purposes. Okay, so on the statement of income, okay, you're going to record your tax expense at 30%. So 30% of 40,000 is 12,000. Okay, and what you owe to the government is 30% of 37,000. Okay, so which is 11,100. Okay, the 30% tax on the difference here on this 3,000 will be paid. This is where you'll pay 30% on that 3,000. Okay, so let's just go through the entry, see what it would look like, and then we'll get our answers. So for 2015, you're going to record a tax expense of 40,000 because this is based on your accounting income. You owe the government tax payable 11,000. Sorry, tax is not 40, it's 12,000. You owe the government 11,100, and the difference is a deferred income tax, taxes that you will be paying in the future, and the difference is $900. So, and it's 30% of 3,000. This is 900. So this deferred income tax represents the tax payable in the future on this $3,000 that will be considered revenue in a subsequent year. Okay, so the answer is here. So let's look at our journal entry to figure out the answer. So assuming, so what answer are we looking for? We don't have a $3,000 debit in the DIT account? No. So the deferred income tax is a $900 credit. Okay, so the correct answer is D. Okay, so that's it for this question. Good luck, and I'll see you next time. Thank you.